All right, let's take a look at a few other stocks in focus today. Kunj Bansal is also joining us this morning. Kunj, let me just bring up BHEL because clearly the star of the session yesterday. Now, we've been talking a lot about the divestment agenda. We've been talking about a whole host of PSUs that are going to be in the limelight on the back of that, from a BPCL to an SCI and so forth. But let's just touch upon BHEL in particular, given the kind of move we saw in that counter yesterday. What's the kind of scope you're seeing in some of these names?
Yeah, so any stocks like these have to be seen in two perspectives. In fact, before that, let's also keep in mind that this kind of sharp up move also came on the back of sharp down move as recently as I think hardly a week to 10 days ago, and for last 3, 4, 5 years that the stock has been continuously falling. In fact, if we look at its last 5 year or so performance, the stock is probably down some 80% odd or so. So to that extent, to any long-term investor, it hasn't added anything. If some short-term traders could take a position at those lower levels, possibly might have benefited, but that happens very rarely. Coming back, so as I said, these movements have to be seen from two perspectives. One, on the basis of the financials and the fundamentals of the company, and two, on the basis of news flow and expected development. As you rightly said, that there is a lot of talk about divestment. Now, the public sector stocks are not going up because of divestment, we all know, but they are going up because this time divestment leading to privatization is something that is more a hope of the market, specifically with at least one or two few stocks. Now, that is the reason why we are seeing this kind of revaluation or the buying interest or a sudden recovery that is happening. A divestment of government stake being sold from one public sector company to the other, like in case of HPCL and ONGs happened, doesn't add anything. In fact, it further leads to deterioration in working of both the public sector companies. Now here, when we are talking of privatization, if that is something that government is really able to take forward, then that is where we will see the re-rating of the public sector space. But within that, again, the focus will, after an initial euphoria gets over, focus will stay only on those one or two or three specific names where the actual privatization takes place. So as of now, I don't think financials or fundamentals or the results are something which are playing on these stocks. It's the development of privatization that has to be watched.
All right, fair enough. So that's the view coming in there. Let's take a look at some of the other names as well. While we're just on the topic, let's talk about OMCs because we're going to have IOC in focus today as well. So from that basket as well, Kunj, just to touch upon whether or not you're expecting GRMs to improve, the overall trend, keeping aside the specific factors for BPCL.
Yeah, so it has always been a challenge to monitor these stocks, specifically the oil refining and marketing stocks, on a quarterly basis. While as an analyst and as fund managers, a lot of expectation of certain numbers on refining margins, profitability, government subsidy receipt and all are built in, but the numbers sometimes tend to digress away quite significantly from the expectation, especially on the quarterly basis. So it's very, very difficult to take a call on the quarterly numbers basis. As I said, the medium term performance of all these public sector spaces specifically will be dependent upon the government's privatization move, whether moving forward or not.
What's been happening with some of the PSU stocks in terms of government ownership, and this is great data. How the government ownership in NTPC over the years has come below 60%. Look, government will keep more than 51% in NTPC. And now I think we are nearing the end of the selling, at least by the government in NTPC. Similarly for IOC, the government ownership in India's biggest oil refining company is now below 60%. There you go. NTPC, the stake has come down from 74% to sub 60%. IOC, the stake has come down from 68% to 52%. Between 2015 and 2019, there has been relentless selling by the government, or the government has been selling the ownership in some of these bluest of the blue chip PSU names in order to meet the disinvestment target. But I doubt that the government ownership in NTPC will go below 51%, which means if you're at 54.5, the headroom for NTPC, the headroom for government ownership in NTPC is very limited now. So that natural dumping which has been happening in NTPC should come to an end. Similarly for IOC and NTPC, or for that matter, IOC, some of these PSU companies are the biggest beneficiary of the corporate tax cut because, being a government company, you pay full tax rates and those tax rates are north of 30%. So I'm surprised that why nobody is talking about, IOC or for that matter, NTPC. Kunj, let's assume that IOC and NTPC has suffered and they've suffered because of government throwing their shares in the open market. But now that government ownership in IOC or NTPC has come below 60%, come below 55%, do you think there is scope for these stocks to rally? Because the natural supply which was on from the government, I think that will get reduced.
Yeah, so my one word answer to your question, unfortunately, is a straight no. I'll of course divulge in the details, and you can possibly call my negative bias towards public sector stocks also, but let me try to justify it with some numbers. Leave aside last 1.5 or a 2-year period in which government has sold stake in public sector stocks through those CPSE ETFs and some other measures. Even if you put on a screen a 5-year or a 10-year or since listing chart of NTPC, for a long-term investor who bought it in the IPO, till date, in my view, broadly, except the dividends which have come, not too many investors buy equity stocks for dividends, although it's a very great dividend paying company. But a long-term investor hasn't got any return in this stock, NTPC specifically I'm talking of. So that makes me question that, what is happening here. And it's not that over the last so many years company hasn't grown in terms of top line, bottom line, profitability, cash generation and so many other things. So it comes back to the fact that probably the ownership is something that is causing. Now to answer further to your question, that when the government ownership will come down to 55, 51, maybe lower also, will the stock start getting re-rated? Probably not. In my view, they will get re-rated when the management gets transferred. When the ownership gets transferred and a free hand is given. In fact, the only 2 examples of public sector stocks completely being privatized I can recall of was IPCL, which was sold off to Reliance and I think subsequently merged into it, and VSNL, which was sold off to Tata with complete management control also. Although in case of VSNL, those land issues and still continue to linger on and are lingering on till today also. But I'm not able to recall. Maybe 1 or 2 more such examples could be there. There was this bread making company and all that. But other than that, it has always been stake sale, the ownership as well as management control, the authority to appoint senior managements, chairmen, MDs and all have continued to remain with the government. The process of doing business in terms of taking approvals, submitting proposals, taking capital expansion and investment plan approvals and all have continued to be controlled by the government. So until that changes, I don't think stake being brought down by the government is going to help. What is going to help in terms of re-rating is only, as I said, stake may continue to be there at a lower level, 20, 25% or 24% or 26%, but the management control has to be shifted to another party. Not that that's a panacea. There have been multiple cases of failures after the government has handed over to the private, or not that the private sector has taken it upon itself to come out with flying colors in all the cases, but that is where my slight discomfort with the public sector investing for the medium and long term investors continue to remain there. As I said, some of these stocks are great dividend yield stories, and quite a lot of them are very good trading bets, excellent for the traders who understand the trading.
All right, so those are a couple of the suggestions there coming in from Kunj. Kunal, we've been talking about a whole host of stocks today, just, to get perhaps a perspective from you as well, from a BHEL, a Jubilant Food, some of these names that have been looking really good, even from yesterday's session. What else do you feel is going to follow through today?
So I think the likes of ITC would be interesting, because I think that stock, which was, I think post-result, the stock corrected. I think that stock managed to make a very good comeback. It managed to break that 260 mark as well, which was a bit of a nagging resistance for the stock for a prolonged period of time. So the stock making a comeback was a very good sign, and I believe that should add to more large cap opportunities for traders or medium term investors. So I think that's one stock which should be clearly into traders radar. The other stock we have to look at it is Tata Motors Twins. So even after that 3 days or 4 days of swift sharp uptrend, many of both of these stocks, Tata Motors and Tata Motors DVR, they've managed to cross back above its 200 moving average, and this is the first time I think in the last 1.5 odd year, the stock has managed to give a breakout above this crucial moving average. The fact that these stocks are not correcting even after that 3 days of sharp up move, I think also indicates that there is more buying or demand which is still available into these stocks. So if there is marginal dips into these stocks, I believe that should be taken as a good opportunity to buy. The supports have of course moved up higher for these stocks. So I think the idea for the markets overall would be to try and latch on to stocks which are trading on high momentum, and especially the ones which have given fresh breakouts, something like ITC, Tata Motors, L&T, etc. So I think the markets could be focused more towards that, and maybe you might see some bit of profit booking or trimming into the other sectors which have been erstwhile doing very well, especially like the large cap auto space, which could see some bit of profit booking.
Okay, let's take a bit of a detour and hear it then from market veteran Madhu Kela. He believes that it's time to find opportunities in companies which have positive fundamentals despite having run their course of positive returns. Let's listen in.
One, holier than Dow. Basically, absolutely no problem. Great companies, but very high valuations. I would find it very difficult to make money. Second are companies which are like, I call it coma mein chale gaye. अब वहाँ पे कोई hope नहीं है, basically. And that there are third companies in between, wherein market perception is very bad, but reality is not as bad as what the market is perceiving them to be. Now, and so these are the companies which can go to any bracket, whether they can graduate and get into investable bracket, or they can slip and get into that bracket of untouchable. Now this is where I think there is an opportunity for an investor at this point of time.
Kunj, the outlook for auto is quite dismal, but a stock like Eicher, a stock like Bajaj, even for that matter Maruti, these stocks are up 15, 20 to even 40% from the recent lows. What are the markets telling you?
So, a very good point. In fact, just to put some statistics in addition to what you said, if we look at the market correction which happened after the income tax cut announcement by the government, around I think 7th October or so, market went down again from 11,500 to 11,100. And then from there, almost one way they have risen to close to 11,900, about 7-8% return. Now, this particular run of the market has been led by a completely new set of stocks. So it is not those standard stocks which we used to have earlier, HDFC Bank, Bajaj Finance and few others. In fact, the surprise leaders or the gainers which have taken the market in the last 7-8% rally in 20 days is metals stock, surprisingly, some of the pharma stocks, some of the newer banking stocks. So quite a big gainer has been Yes Bank, and then ICICI Bank led by its good results, and SBI Bank little bit. As I said, some of the pharma and some of the FMCG names. So, and of course auto, as you said, I think Eicher has moved up 20% or so in last 20 days. Maruti also, I think 10-12% or so. My numbers could be here or there. Tata Motors, again another surprise, 40-50% return or so in the last 20-25 days. I think if we look at the stock market movement, probably market is telling, and if we believe in something called smart money, which I at least partly do, then it is telling that smart money is looking at a recovery in the sector. Now, whether that will be a false signal, and can the stocks come down again? Can the sector again show signs of no recovery and slow down again? Possibly yes, but at least as of now, that is what it is showing the sign. Not only OEMs, even auto ancillaries, if we look, the kind of recovery they have shown is showing that there are signs of recovery that are happening. There have been news items and news reports of sales picking up in 3-4 days closer to the Diwali, although on a YOY basis they could possibly continue to remain lower. But I think all the negatives are in the news. All the negative news is in the price, is in the valuation. The EV threat, which had suddenly looming over very largely, seems to have subsided for now. And as a result, a contra investor for a medium term wanting to take a position, somebody who has been looking for valuation also, because we have a market which on one hand, a good quality stocks, the valuations have now not left any boundary. So that is where one can take a call. Yes, in the short term, because of the rise that we have seen, for traders it could be a negative surprise also.
Before you get excited about the FI data which came yesterday, this is the fine print, which is that yesterday's FI data of 7,100 and 92 crore includes HDFC Life stake. Yes, it's not like FIs really bought 7,000 crore worth fresh stocks. There was an HDFC Life block deal. The block deal has happened where Standard Life has sold and foreign institutional investors have really bought into it. The deal was worth about 6,000 crore. But if I strip it off also, the number from the FI front stands at a tall 1,100 crores. Kunj, do you own any insurance stock? If yes, which one?
Yeah, we do own HDFC Life in some of our client portfolios. I personally own some of the life as well as general insurance companies from their IPOs about 2 to 3 years back. So that's the answer to your question. I don't know if you want to know the reason and the question on the valuation, then I can talk about that also.
Now that you've kept these stocks for 2 years and they're up 50 to 100%.
Yes. So there has been a pattern. In fact, especially the life insurance companies after the IPOs initially did not perform for 1 to 1.5 year period. General insurance companies continued to perform. Now, of course, last few months, 6 to 8, 9 months, almost all the stocks, the whole sector has performed, has got re-rated. And thankfully, the sector has supported it by delivering the performance. If we look at the growth number of the insurance companies, both life as well as general, they have continued to report growth rates, whichever terms we take in terms of value of new business, in terms of APE, anywhere in the range of 20 to 40%. So the factor that we always continued to talk, like in case of equity market, we used to talk and we still talk that India is under penetrated. So was the case obviously with insurance, that Indian market, despite LIC, GIC having been there for last 50-60 years, Indian market remained largely uncovered. And I think that is where the private insurance companies have really been able to make a dent. They have been able to cover the market, the increase the coverage, the number of people, and that's where they have been able to achieve these kind of growth rates with profitability. So the important part is that also that it is not resulting into too much strain or drain on their financials. They have been reasonably from different one company to the other to the third. If we look at reasonably decent movement towards the improved financials, which have already come and which will come over the years. Also, let's keep in mind that this is a sector which is a relatively new sector in the market for last 2.5, 3 years. There were no listed stocks available in the insurance sector. So any new sector always has a novelty value and therefore attracts extra buying, because the institutional as well as individual investors are yet to come to own the sector.